All right, people, welcome to Chapter 12, Cash Flow Estimation and Risk Analysis. This is the last chapter before the semester ends. So first, we have learned capital budgeting in Chapter 11. So basically, we learned the different methods to evaluate the project and to find out whether the project is successful or not. Previously, we just took the cash flows as given. So based on the cash flows, we calculated the NPV and the IRR and the payback periods and whatnot. And in this chapter, we're gonna explore how the cash flows are developed. And also we will learn how to analyze the risk in capital budgeting scenarios. So the first thing we want to know here is free cash flows. So basically, our NPV is determined by the discount rate, which is the cost of capital. We learned that in chapter 10, and the free cash flows. And these cash flows are not accounting income, and this is very important because in accounting income, depreciation is all involved. When you have this EBIT, earning before interest and taxes, or EBT, other name is taxable income, and also net income, these are all after depreciation is deducted from sales. And since depreciation is not exactly a cash term, so the net income and operating income, as well as after depreciation, these are not cash term either. So to solve the issue, we need to add depreciation back to the cash flow, to the net income, to retain the cash flow feature. And also taxes are cash flows. So previously in chapter 3, the statement of cash flows, we learned that net income has to be combined with depreciation. So basically, net income plus depreciation is sales minus costs minus interest minus taxes. So sales, cost, interest, taxes, these are all cash terms. These four items are equivalent to net income plus depreciation. If you consider net income and depreciation separately, they each are not cash flow term. And the second of all, this free cash flow name gets from the freedom from financial cost. It is true that the company pay cash debt holders and also pay dividends to stockholders, but we do not count this dividends payment and interest payments as part of the cash flows, which later we use to calculate the NPV. So in other words, the interest and the dividends, those are financial costs. Those are in dollar figures. They are not in the cash flow. So where do we count them? In chapter 20, we learned we're going to count them as part of the cost of capital, which is a percentage. Okay, so basically, if the company paid $10 million for interest, assuming $100 million debt, so then the cost of debt is 10 million divided by 100 million, which is 10%. And the cost of debt will be used, will be incorporated in the weighted average cost of capital, because you also need to incorporate cost of equity, which could include preferred equity and common equity. So after you combine all these cost of capitals, you will have this discount rate. The overall discount rate, the other name for it is a weighted average cost of capital. So here is the free cash flow formula we used. It is developed based on the capital budgeting plan, and you can find all the numbers from the balance sheet and the income statement. Okay, so I skipped this in chapter 3. I skipped this in chapter 9 again, but this is the final chapter, so I will not skip the definition of free cash flow. All right, so right here, if we explore further about the relevant cash flows, so we have opportunity costs, okay? And opportunity cost basically occurs when you are using a new project to replace the old project. The old projects may be still profiting, okay? It can still make money, but if you are abandoning it, actually you lose the opportunity of making money generated by the old project. Okay, so that loss of revenue would be a negative cash flow you need to put in the table. Okay, and once again, the opportunity cost occurs only when a project is replaced. In particular, a profitable project is replaced. For most of the questions in this chapter, the projects usually start from scratch. There's no old project to be replaced, so opportunity cost may be 0. The second part for relevant cash flows is the set effects. So the set effect could be erosion effect. It could also be synergy effect. So following the definition, a erosion effect is the loss of a profit when a new product reduces the cash flows from existing projects. For example, if a Target open another branch, open another store by St. Xavier, which would conflict its store on the 95th and 50th Avenue. So since the two stores are too close, the cash flows of the existing store may suffer because of the established of the new store. So that's called erosion, and it can also be called a cannibalization. And the synergy basically is the opposite. That occurs when the new projects improve the cash flows of existing projects. For example, I'm running a multi-business company, and I just acquire a new advertising firm. Okay, the addition of this advertising firm will help me reduce my advertising cost, and also it will bring revenue to my own new advertising firm. As you can see, the cash flows of the existing projects of the existing business will benefit from the new advertising firm I acquired. And also, the last one is the taxes. This is also part of your cash flows. So what are the irrelevant cash flows which we do not put in part of the NPV calculation? Right, so the ones would be the sunk cost. The sunk cost, following its definition, is a cost that has already occurred. In the past, we may spend money for consulting, for marketing analysis, for cost analysis. All these costs are definitely solid dollar figures, but because they occurred before the project actually started, they occurred at time -1 or -2, okay, 1 year before or 2 years before the project starts. As long as before time 0, the time the project starts, we do not consider them as part of the cost. Okay, another big part is financial cash flows. These financial costs will eventually be incorporated into the weighted average cost of capital, which served as the overall discount rate for all the cash flows. Okay, but these financial cash flows, like dividends or interest, although they are dollar figures, they are not part of the operating cash flows. All right, so how do we calculate our operating cash flows? So the operating cash flows basically is EBIT, earning before interest and taxes, which is sales minus costs minus depreciation. And then we just deduct taxes away. It's very important you should realize that interest is not deducted. Okay, we do not deduct interest because interest is a financial cost. We put it somewhere else, just not as part of the operating cash flow. And then we have to add back depreciation, okay, to recoup the non-cash effect resulted from the deduction of depreciation in the first place. So the EBIT basically is, sorry, maybe I did not mention depreciation. Let me repeat again. EBIT is sales minus costs minus depreciation. Okay, so if you expand EBIT, the sales minus cost minus depreciation, then since you need to deduct taxes away, right here you multiply by 1 minus tax rate. Okay, then you add depreciation. In this formula, you will see that depreciation appeared right here and appeared again right there. If you do some math technique, you will find depreciation is singled out. Okay, so basically you have a sales minus costs, okay, times 1 minus tax rate, and you add depreciation times the tax rate. In other words, depreciation basically is a tax shield. Okay, so the higher depreciation, then the company would end up with less operating income, then they would have a less taxable income, and then they would pay less taxes, and therefore resulted in higher net income. Okay, so when the company pay less taxes, they have more cash flows. Therefore, the depreciation actually plays a positive role in the company's cash flow plan. Okay, so that's the cash flow from operations, where operating cash flows occurred on an annual basis. And we also have a cash flows occur one time, which is cash flows from a capital spending. Okay, it's usually paid upfront, or it can be salvaged at the end. Okay, like say if you start a business, you have to buy a $1 million machine and have it set up, and then after 5 years, when the business is gone, you sell the machine for some salvage value, and that's cash flows from capital spending. And you also have changes net working capital, and we know that net working capital is current assets minus current liabilities. Usually, if you start a new business, the net working capital is mostly represented by cash and the inventory, okay, because you just started a new business or add a new production line, you definitely need to maintain higher inventory. And if you buy inventory, then what happens to your cash? You're certainly going to spend money, so your cash will drop. So here we have an example. Let's say if you are running a shopping mall business, you definitely, you're running a shopping mall business, you have different stores in the mall. You have a cell phone store, you have a clothes store, a shoe store, and all these different stores. And now you want to add a jewelry store as the new business. And definitely you're going to spend money to buy the place within the shopping mall and also do renovations, and those are the large amount of money you spend up front. And this is a capital expenditure. And this will appear on the fixed assets on the balance sheet. And then, because of the new business, you have to buy new inventories. You have to buy all the sapphire, golds, necklace, and diamonds. And that's going to help you boost up the inventory so you can keep the selling business running. And when you build up the inventory, your current assets actually increase, your working capital increase, and then you are required to spend cash for that increase of inventory. Okay, so usually the net working capital is inventory plus account receivable minus account payable. So when you start a new investment, when you have a new business, definitely your scale of operation is enlarged. So all these terms, inventory, account receivable, and account payable, they would increase. So here, what you see is, oops, I just shrink myself. Here, what you see is a balance sheet before the project's established. You see without the projects and with the projects. So what you see here is when the project is adopted, the account receivable actually increase, the inventory increase, and also the accounts payable increase. Okay. And when assets increase, the cash flow effect is going to be negative. You spend cash for those expanded inventory and accumulated account receivables. And also when your account payable increase, that helps you save cash. And we have been through this